Hey traders, welcome back to a brand new video. If you guys are new to the channel, please hit the subscribe button, and if you guys are regulars, please hit the like button. So in today's video, I'll be teaching you guys how to take snapper entries like this, or like this, or like this in just a few trading steps. Watch until the end as you guys will see how I take trades with zero drawdown and the highest risk to reward ratio. If you guys also stick to the end, I'll be giving you guys a bonus tip on how I take these trades and maximize my profits and minimize my risk. Yeah, other than that, guys, let's get into the video. So alright traders, so we are on the laptop now. I want to show you guys how sniper entries form on the market. So in the market, we have two types of sniper entries. The first one being the trend continuation pattern. So this type of sniper entry capitalizes on the uptrend or the trending market, which in this case is the uptrend, and we look to enter within what the market is doing, which is uptrending. And then the second type of sniper entry is a reversal pattern or a counter trend type of entry. So this goes counter trend. So like in this market, we have an uptrend, and what we look to do is enter on the reversal of this trend. So guys, this is my favorite entry. I want to show you one that I caught earlier on this week. So traders, this is the trade that I took earlier on this week. It's a nice trade with a 1:10 risk to reward ratio, and this type of entry is the reversal. As you guys can see, there's a downtrend of the market, and we look to enter on the reversal of this downtrend. So I'm gonna show you a 5-step process on how to catch such entries in the market. So guys, the first step is I identify the momentum of the market. So basically what the momentum of the market is basically where is the market heading to. So how many candles does it take to head in the direction that the market wants to go. So as you guys can see, from this point on, the market takes 1, 2, 3, 4, 5, 6, 7, 8, 9 candles to get to this point. But how many candles does it take to get to this point? It takes more than that. So we know the momentum of the market is an uptrend. So we know this in this market, we're in an uptrend market. So in an uptrend market, what do we look for? We look for buys. So while we're looking for buys, what I do is we look for our demand zones. So how we identify demand zones is we look for areas where the market tends to stop and stall. Like in this area, I can see that the market has touched this area a lot, and it's either the market has went down, came back into this area, gone down, or the market has went up from this area, came back and touched into it, and touched into it again. So I know this is my demand zone. For everything else, I need to know where the market is ranging, guys. So how to know where the market is ranging? You start from the very bottom of the market, since it's an uptrend market, and you identify your low. You start from the very bottom of the market and you identify the low and the high and the high. So from this market, we see a break of structure marking out our new low, your new high, marking out our new high and our higher low. So guys, now that I know that the market is ranging between this and this, what I do is I look for another break of structure, which is this one. So now we know that the market is ranging from this low to this high. So now that we know that the market is ranging from this low to this high, I pull out the firm to know if the market is in a premium or discount zone. So guys, what we do is in a ranging market, we look for sells in the premium zone, and in the discount zone we look for buys, or that's where we put our demand zone. as we can see in our discount zone. But I usually call this guy guys, I usually call this area the golden zone, where I usually look for most of my setups. It always works, which is in between the 50% and the 100% of the area called the golden zone, which is my 0.786 zone. And between these two areas is my premium zone, where my discount zone, where price is cheap. So I'm gonna mark out my demand zone here. So this is where my demand zone. Let me remove this so you guys can see. Knowing that my demand zone is here, I would usually look for entries on where the demand zone starts, and look to target these highs and put my stop loss just below the lows. But as you guys can see, this risk to reward ratio is not that nice. So what we tend to do is we go on lower time frames and look within this demand zone and look to see if we can look for finer refinements and refine our demand zone into smaller bits. As you guys can see, this is our demand zone, and we can refine it to this area over here, which is the lowest point. So we always look for the last candle before the buy, and we can even go on our 15-minute chart to refine it even further. This is our demand zone. So it's the last sell before our buy, which is our demand zone. And if you guys look now, this is where the market tapped in. But guys, before you enter, we need to look for liquidity zones. So what liquidity is where there's a lot of buyers or sellers under the previous highs or lows. So an area like this is an area of liquidity, and also here liquidity. So guys, you can't enter trade without identifying the liquidity, because then that will mean you guys are the liquidity. So what we do is, because I could have entered here, I could have entered here, but these are liquidity zones, knowing that the market might go to the lowest point in our discount zone. That's step 3. Step 4 of our process is looking for smaller. Step 4 is identify entry patterns on the smaller time frames, like the 15-minute chart, guys. We do not look to just enter based on this demand zone here. As you guys can see here, we can be liquidated because this is also a liquidity area. So what we do is we look to enter we look for reversal patterns on the smaller time frames. If I show you guys here, what we have here is a break of structure just there, and then if I go down to the 5-minute time frame, if this allows me, so guys, on the 5-minute time frame, I have a break of structure there. I have a break of structure there, and then I have another break of structure here, just here. I'm just gonna fix it for you guys. So our break of structure there, meaning that the market is still trending down. But now if we've broken the high that broke this low here, that means the market is changing direction, which means there's a shift in the market. This guys is otherwise known as the change of character. So what I do is, after I see this within my demand zone, I look for what I call an order block within these zones. So basically what an order block is the last down candle before the upward movement, which is this one. And my entry would be here. This is where my entry is. As you guys can see, zero drawdown. I would usually put my my stop loss just under these lows for a finer what you call this, for a finer risk to reward ratio. But just to cover any losses, just to cover any drawdown, I usually put it just under these lows. And as you guys can see, the market reversed here and started going up. So the last step of our process is to show you guys our exit zones. So knowing that this is my high in our range, I know that the market is looking to break this high and create a new range. Therefore, I'll target these highs where there's also equal high liquidity. Target these highs and let the market liquidate this, and this would be my exit zone.